Okay. Is that working? Yeah. All right. So up to lecture 17, making choices over time. Delete that. Okay, let me close that.
All right. Okay, let's get started.
And before this we did, monopsony? Was it a labor yeah. Labor and capital demand as inputs into the production side, I guess. Yeah. Great. Let's do it.
Today we're going to continue our discussion of factor markets, but really what we're going to focus on today is essentially taking the insights for capital markets and thinking about how individuals and firms make decisions over time. Last time we talked about the interest rate and its role in equilibrating capital markets. We talked about the demand for capital being driven by the marginal revenue product of capital. But then the more interesting side was the supply of capital being driven by individual decisions on how much to save. That savings went into either the bank or into corporate bonds or stocks, and that's the money that firms borrow to make investments. This lecture is basically going to dive into that and think about, in the real world, how do we think about these savings and investment decisions? Decisions that will be so important to you as individuals and maybe someday to you as business owners or executives. I want to start by discussing the key concept of present value. One of the most important concepts in both economics and finance is the concept of present value. The basic idea of present value is quite simple, which is that $1 in the future is worth less than $1 now. And the reason $1 in the future is worth less than $1 now is because you had that $1 now, you could save it and make interest. So delaying getting money till the future has an opportunity cost. You've missed the opportunity to earn interest on that money today.
But yeah, I mean, opportunity cost of the interest. But you know, like, of course, like the opportunity cost of all the other stuff you could have done with it, right? You could have put it into capital or, you know, a million things.
So
essentially,
the idea is you can't just add up money that comes in different periods. You can't say, if I have $1 today and $1 in 5 years, $1 in 10 years, that's $3. You can't make that statement. Those are not the same thing. That'd be like saying I have a pound of gold and a pound of apples and a pound of butter, so I have 3 pounds. You wouldn't say that. You'd say, well, those are worth very different.
Unless interest is more like a more broad term. But like, you know, if you're investing in like S&P 500 and you're getting like 10% back a year, not accounting for inflation, then yeah. But anyway, okay.
Different things. I can't just add them up and put them in one unit, which is pounds. Likewise, you can't just add up dollars today and dollars in the future and put them in one group and just say they're dollars. You need to actually think about how to put these into common values. So with apples and gold and butter, we might use dollars. Okay? With money in different periods, we're going to use the concept of present value. Essentially, what we're going to do is we're going to take all future dollar flows and translate them into today's terms. The present value of $1 at any point in time is what it's worth in the present, what it's worth today. Okay? So, in the present terms, what it's worth today. Of $1 at any point in time is what it's worth in the present, what it's worth today. Okay? So suppose, for example, that the interest rate is 10%. Okay? And you start, and that you want to have one.
What is that? Is that? What is that symbol? Is that? It's not omega. Symbol. No. It's not gamma. Oh, it's gamma flipped with a dot on top. Gamma symbol flipped horizontally, no, vertically with a dot on top. Mirrored lowercase gamma vertical flip, but there's not like another symbol that looks like it. Okay, this is okay. Okay, I don't know what that is.
$100 next year.
Have we already gotten the symbol for interest? No, this is the first time we're talking about interest, actually.
Would like to have $100 next year.
I don't know.
Well, so in other words, you know that if you put some amount Y into the bank, at the end of the year, what we have, you have Y times 1 plus I. That's how much you'll have at the end of the year. You'll get your money back plus the interest. And you want that to equal 100.
Hold on. Is Y...
You know that if you put some amount Y into...
Y is... Can I do that? Whoops. Y income. Okay.
The bank. At the end of the year, what we have, you have Y times 1 plus I. That's how much you'll have at the end of the year.
Yeah.
You'll get your money back plus the interest. And you want that to equal 100. That's the equation you want to solve. You want to have $100 at the end of next year. That means that Y equals 90.9.
Yeah.
That's messy. 90.9 is Y. That's the amount you have to put in the bank today to have $100 in 1 year. Inverting that, that means that more generally, the present value
of 100 next year
of
is
any
90.9
amount of money
this year.
is its future value over 1 plus the interest rate to the t, where t is how many periods in the future you get the money.
Right. Over 1 plus... okay, what? Symbol for interest in economics. What symbol is used to represent interest in equations in economics? What? Force of interest? Okay, maybe is he just writing I in a weird way to me? I don't even know, to make it clear on the white. I don't even know. Okay, we're just gonna go with I for now. We're just gonna go with I. IT. Let me do. Yeah. Oops.
Over 1 plus the interest rate
Yeah.
to the t,
Yeah.
where t is how many periods in the future you get the money.
How many periods in the future? Oh. Well, okay, yeah. So if it's like per year, then you're talking about like if the interest rate is per year, then it would be the number of years, like the and so if years, if the interest is in years, then the period, then t refers to however many years in the future. Okay. We don't need this. Delete that. Boom.
So if you get the money in 1 year, the present value of $1,
This is pretty basic.
$1 in 1 year is 1 over 1 plus the interest rate.
Yeah.
$1 in 2 years is 1 over 1 plus the interest rate squared, and so on. Essentially, this is a set of weights.
What's it? Is it to the
1 plus the interest rate to the t.
Oh, okay. To the power of okay. Is that gonna nicely? Do I do that? Yeah.
Where
okay.
t
Nice.
is how many periods in the future you get the money.
Okay.
So if you get the money in 1 year, the present value of $1 in 1 year is 1 over 1 plus the interest rate.
Yeah.
$1 in 2 years is 1 over 1 plus the interest rate squared, and so on. Essentially, this is a set of weights that allows you to value dollars in all periods in today's terms by putting them in present value.
Okay.
Okay? So suppose, for example, you come to me and say, look, John, I want to borrow $30. I'm going to pay you back $10 each of the next 3 years. And let's say the interest rate's 10%. I would say to you, well, that's a bad deal for me. Because what's the value of the stream of payments you're going to give me? You're going to give me $10. You're going to give me $10 next year. Okay, you're going to give me $10 next year. So that's worth 10 over 1.1 to me. Because if I had it today, it would have been $11 next year. You give me $10 in 2 years, well, that's worth 10 over 1.1 squared. $10 in 3 years, well, that's worth 10 over 1.1 cubed. So in other words, the $10 you give me each for the next 3 years is only worth $24.87. I can't just add it up and say, we're going to give me $30, so I'll give you $30 today. It's not the same thing. Because if you give it to me today, it's worth more than if you give it to me in the future. Likewise, if you give it to me in the future, it's worth less than if you give it to me today. And the reason is simply that I can translate a given amount of dollars today into more dollars in the future through savings. Since I can do that, since I can translate that, money's worth less in the future. Okay? So more generally, if we write a formula for the present value of any stream of payments, okay, it's going to be how much you're going to pay. Let's imagine a present value of a fixed stream of payments. Let's call that F. Let's call F the amount you're going to pay back was $10 in our example. Times F times 1 over 1 plus I to the first plus 1 over 1 plus I to the second plus ... all the way to 1 over 1 plus I to the t.
Okay.
Where t is the last period you're going to pay me back.
Right. So it's just it's just this, but extended to like however many, like if you're like spreading it out.
So you pay back over 10 years. There's 10 terms in this equation. 1 over 1.1, 1 over 1.1 squared, all the way to 1 over 1.1 to the 10th. Okay, that is the equation for the present value of a stream of payments. That's a very messy equation to evaluate once the number of periods gets large. And that's why we typically use a shortcut, which is we consider the case of a perpetuity. A fixed payment you'll get forever. If you do an infinite sum of that equation, some of you will know that that will yield you that the present value of F forever is simply F over I. That's the infinite sum of that equation. So there was $10 for...
Huh.
forever at a 10% interest rate is worth $100. Equation. F over I. That's the infinite sum of that equation. So there was $10 forever at a 10% interest rate is worth $100.
$10 forever at a 10% interest rate is worth $100? Okay, I don't really get it, but
it's the value of the payment over the interest rate I'm earning. And that's a convenient formula. Now, stuff never goes on forever, but if you think about t getting large, then you could converge to using that formula as a shortcut.
Okay.
So we'll typically give examples in this class with small numbers of periods.
Usually, with so many of these lectures, there's something that I don't understand at the start, and then like this, and then he'll give it a great example, and
T getting large.
It'll be all cleared up. So this is a shortcut. Okay, so this is the shortcut for the above equation. Yeah. So $10. Yeah, I don't
Then
really
you
get
could
it, but
converge to using that formula as a shortcut. So we'll typically give examples in this class with small numbers of periods or incredibly large numbers of periods to allow you to use that shortcut. Because having you evaluate this for 12 terms is just a pain in the ass. Okay? So that's sort of
the shortcut. Okay.
of a shortcut we can use as the number of periods gets large. Okay? Questions about that? Now you might also want to know about you might want to invert it and say, you might want to know about the future value of a given stream of payments. You might say, look, what happens if I save $10 every year? What am I going to have in the future? So, for example, if I save $10 this year, next year I'll have $11. I'm always assuming the rate's 10% for now. But then let's say I save that. I leave that in the bank. What will I have the next year? Well, the next year I'll have 1210. Why will the increment from 0 to 1 be small and the increment from 1 to 2? Why will it be smaller? Because I've not only saved the $10, I've saved the extra dollar. And that extra dollar itself earns interest. And indeed, at the end of T years, you will have that the future value of a stream of savings is y times 1 plus I to the t, if you save for T years.
Okay. Okay. Present value. Okay, so we've got oops. To the t. Okay.
And this illustrates the beauty of compounding. The beauty of compounding is that when you put money in a savings account and let it sit, you not only earn interest on what you initially put in, you earn interest on the interest. And over time, that actually becomes the larger part of what you save. Over time, the big issue is not what you put in. The issue is all the interest you're earning, the interest you're earning on that interest.
Yeah.
Okay? So basically, to sort of work that out, let's consider an example. Let's consider you making a retirement savings decision. You might think, Retirement, geez, I'm not even in college yet. Like, take it easy, old man. I'll worry about that in the future. Well, actually, I'm going to tell you why you shouldn't worry about it in the future, why you should worry about it now. I'm going to illustrate that with a simple example, okay? Imagine you plan to work from age 22 to age 70, okay? Imagine that's not a crazy guess for your working life. You work from 22 to 70, okay? And let's say the interest rate is 7, so you're going to work 22 to 70, and let's say the interest rate is 7%. Okay? That's our assumptions. And I'm going to give you two choices for a retirement savings plan. I'm going to give you two options. Option one for retirement savings plan is you're going to save $3,000 every year right away. You're going to start saving $3,000 every year for 15 years, and then you're never going to save again. So from age 22 to 37, you're going to save $15. You save $3,000 a year and then never save again. $5,000. You might be tempted to multiply 3,000 by 15. Say, well, at 15 years old, 45,000. That's wrong because you miss compounding. You miss the fact that all the savings is also getting interest on it. So 15 years, you already have much more than just multiplying those two. But that's not all. You then let that sit there till you retire. So you let this money sit there, okay, for the next 33 years. After 33 years, this turns into 75,387 times 1.07 to the 33. Okay, so by the time you retire, you have $703,000. By saving $3,000 a year for 15 years, by the time you retire, you have over $700,000. Let's do an alternative savings plan. What most people do, which is, hell, I'm not going to save retirement when I'm 22. That's nuts. Let's say we do instead is you don't save anything until you're 37. You don't save anything for the first 15 years, and then you start to save. Then you start to save $3,000 a year. So 0 for 15, and then $3K for 33. If you follow that savings plan, by the time you retire, you are going to have $356,800. You're going to have half of what you...
Hold on, I have an idea. I'm just going to put it into my tasks. I think as we continue on, and maybe I'll go back through all the previous lectures as well, I just want to have a very short summary for myself. Or is this just doubling up my tasks? Nah, that's fine. Which we'll add to as we go through, of like the super important key things that I want to remember, like really, really remember. And we'll put that in a heading at the bottom. And okay. And basically, the present value of any number of income streams at any point in the future can be calculated. That's a key thing. And yeah, the present value, yeah. The present and future values. Yeah, I mean that
you had with the first plan.
Doesn't seem.
Why? Because of compounding.
Too complicated.
The way compounding works, the more you can get in the bank earlier, the more money you'll end up with, because you earn interest on your interest. How many of you have been to the Science Museum here in Boston?
Remember.
Okay, a few of you. Well, you probably haven't been to the little kid part, but I have. And the little kid part in the Science Museum has these cool 3 ramps. And one ramp is flat and then steep. One ramp is steep and then flat, and one ramp sort of in between. And you have kids put the marbles on and see which goes faster. And of course, the one that goes fast is the one that's steep and then flat, because you take advantage of the acceleration over the flat part, relative to the one that goes flat and then steep. That's just compounding. Okay? Compounding is simply like getting the velocity up early. Okay? You're going to get there faster. So this is an important lesson, not just for mathematics, but for you, for thinking about your decisions. You, when you get a job, most of you are going to get a job in a good firm that's going to offer you an option of retirement plan. You are going to think, why should I bother? I'm superhuman. I'm never going to retire. Okay, the answer is you're wrong. You are going to retire. And every dollar you put in now will be worth so much when you retire that it's actually worth deferring consumption now. Remember, capital is deferred consumption. So the decision you'll face when you join your firm is, should I defer today's consumption to have money for the future? And the answer is...
Capital is deferred consumption. Deferred? Hold on. Capital. Oops. Capital. Capital is deferred. I don't think he's said it like that before. That's... Hold on. Capital? Yeah, I hadn't thought of it like that, but that... Yeah. Because I was just thinking of capital in terms of like, buying a building or whatever for your firm vehicles. But I guess it's... But like, I guess, yeah, I like say if you buy a building for your firm, then I guess the if we're thinking about capital as deferred consumption, I guess we're saying, look, we could have consumed like the day we bought the building, we could have consumed that money on that day instead. And instead we're kind of like, basically like we're consuming that money. Well, I mean, like we're consuming the good, which is we're consuming the capital, which is the money we spent on building the building for however long the building lasts, right? And so I guess, yeah, we're deferring it, like in compared to like, yeah, consuming all that money now. Okay, yeah, I mean, yeah, that's interesting. Capital consumption. Yeah.
And the answer is you should defer money to consumption for the future. Moreover, it's even better than that, because most of you will work for firms which offer a retirement plan called the 401k, which is tax preferred. What that means is if you take the money home today, you pay tax on it. If you put it in your 401k, you don't pay tax on it until you retire. Now, why do you care if you're going to pay tax anyway? Why do you...
Because there's... I guess like capital... So, is the idea that, say you have $1,000 in the bank now, we're calling that... that is capital. But but it's a little bit different to spending the $1,000 on, buying something for your business. But I guess that's all capital, because you're like, whether you buy the thing for your business or whether you have it in the bank or whatever, invested, accruing interest. It's it's generating income. Like, yeah, it's generating income in the future, and it is holding some value that you could have chosen to consume right now. Yeah, that's yeah. Yeah. $4,000. Just writing this for my own. If I get confused in the future. Like whether you're buying, like park it in the bank, accrue for it to accrue, two C's, interest, buy SP 500, or buy physical, machinery for your firm. Like all of these are deferred consumption.
I don't care if you pay tax today versus paying tax when you retire. Well, the answer is, just like $1 in the future is worth less than $1 today, paying taxes in the future is effectively cheaper than paying taxes today. Because you're paying taxes with future dollars that are worth less than today's dollars.
Yeah.
So by deferring your taxes, just like I don't want to defer my getting repayment from you, by deferring your taxes, you save money. It's even better than that, because most employers will match what you save in your retirement plan. So when you go to a firm and you start a new job, many employers will say, well, the first $3,000 we'll match you dollar for dollar. This is an unbelievably good deal. You're going to get the compounding for the next 50 plus years. You're going to get a tax break, and your employer's going to help you out. So you should absolutely save as much as you possibly can, as early as you possibly can, for retirement, okay? Because of the beauty of compounding. Let's think of a real-world example. How many of you heard of Bobby Bonilla? Anybody heard of Bobby Bonilla? I got a couple I got a few head nods, 3, 4. Okay, Bobby Bonilla was a good but not great. Well, I said at peak great, but mostly good baseball player. He played for the Mets at the end of his career, but by the end of his career, his talent wasn't worth the salary they were playing him. He sort of fell off a cliff pretty quickly, and it wasn't worth the money they were paying him. So they offered to buy him out. They said in 1999, we'll give you $6 million to just bag your contract and leave. You want to play baseball anymore, you can retire, pay $6 million out the door. He said, that's a great idea, I'm happy to do it, but I don't really need the money right now. How about if we change the deal? How about if we said we defer the money from 1999 at an 8% interest rate, and instead I'll collect it over the 2011
What did I do? Oh. Okay.
to 2035 period. So I'm deferred for 20 years at an interest rate and then collect it over a time period. The way that worked out for him is that by the
Why is that doing that? I'm editing somewhere else in the document on another monitor, and it's screwing it up here. Weird.
time his money started being paid out in 2011, his $6 million was worth $30 million. So he basically gets $1 million a year till he's 72 years old. Indeed, there's Bobby Bonilla Day, which is the day the Mets pay Bobby Bonilla $1 million. Okay? So basically, this is a guy who understood compounding, understood the value of deferring, and now he gets $1 million a year till he's 72, instead of just getting $6 million at once back when he was young and didn't need as much. Okay?
I really wish that the convention for typing dollars was after the number, because that's how we say it, and it just feels way easier, way more fluid to type.
So this is the value of deferring, the value of compounding, which is save early and save often.
Rather than
okay?
$1.
Questions about that? Yeah.
Anyway,
this one? Oh, I simply use this formula. I mean, simply.
Or the convention for speaking was to say $1.
Well, that's a great question. Basically, it's sort of approximately infinity. We will let you know in a problem whether you can use that shortcut or not. But roughly speaking, we're not going to do problem if we calculate this over 10 periods. We'll give you a short number of periods, or we'll give you a huge number of periods, which is effectively infinite. But we'll let you know. Okay? Technically, in the real world, not an exam, you have to do it this way until you get to infinity. This is just an approximation.
Oh, okay. Yeah. Just an summation in the real world, we need to, yeah, I mean, that makes sense. Okay, so this is approximation for learning about the subject. I mean, yeah, in the real world, you want to really split everything. Calculate it the long way. Okay. Okay, I was taking it to literally or take it too seriously, but yeah, if it's just a education device.
But in practice, it's a pretty good approximation once you get out like 30 periods. Depends on the interest rate. The higher the interest rate is, the fewer periods you need to go out for that to be a good approximation. The lower the interest rate is, the more periods you have to go out for that to be a good approximation. Okay, other questions? All right, so now, yeah. You talk about the tax piece? But the point is with the tax, the point is, think of it this way. If I pay taxes today, let's say I pay $1 taxes today versus $1 taxes in the future. Okay? The $1 taxes today that I pay to the government, they get to earn interest on.
Yeah.
Whereas if I hold it, I get to earn interest on it. So as long as the tax rate's less than 100%, I get to make, if the government holds the money, they make the money. If I hold the money, I make the money. Better for me to make the money. Does that make sense? Good question. Other questions? Okay, now, some of you may be thinking, this is all well and good, but shit's gonna cost more in the future.
Is there a hotkey to change the playback speed? Because usually I need it to go at normal speed, but right now it's right now we can go through quicker. Shift period. Oh.
Bobby Bonilla making $1 million in 2030 is buying much more expensive stuff than Bobby Bonilla was buying in 1999. What about that? What about the role of inflation? So let's talk about inflation. In other words, in my discussion so far, I assumed prices didn't change, but in fact, prices do change. They go up. Okay? We typically measure that by something called the Consumer Price Index. The Consumer Price Index is essentially a measure of what a fixed basket of goods costs over time. So essentially, define a basket of goods that a typical person would buy, and they go and measure every quarter. They literally go to stores and say, what does this cost? So a fixed basket of goods includes one men's shirt. Okay, let's go see what the average price of a men's shirt is. It includes one women's shirt. Let's see what the average price of a women's shirt is. It includes 67% of a new, or 12% of a new computer. Let's see what a new computer costs, etc. So they basically have a set of weights that are determined by a consumption bundle. Say for that set of good weights, what does it cost by the same set of things over time? And that gives you an index value. And that they normalize it to 1 at the year 1982 for some arbitrary reason. So basically, the CPI says, what does stuff cost relative to what it cost in 1982? And you can see that in figure.
What does stuff cost relative to what it cost? 1982. Okay.
Figure 17.1. Figure 17.1 is a graph of the CPI.
Is it the same for Australia? What year is the CPI for Australia normalized to? (2011 to 12). Hold on. Let me. Index reference base. Oh, okay. Oh, ABS changed index reference in September 2012 from. Oh, okay. Okay, so what does this 140 mean? Does this mean something that cost $1 in 2011 to 12 costs $1.40.7 and 7 cents now. Is that what it means? Well, let's keep watching, and he'll explain it. So what have we got here? We've got and let me actually put in my notes.
What you
for Australia, it's 2011-12.
can see is basically
Okay, so index, so 100, 1984. Okay.
it's identically 100 in 1982, and it's rising before and after 1982. You can see that
What's the index 1982 to 1984? I guess it takes a while to get the measurements or something.
the rise
like
is
over 2
relatively
years?
rapid in the 1970s. Okay, in
Boom. Boom.
This is relatively rapid in the 1970s, okay, in percentage terms. That was a lot of inflation in the 1970s into the 1980s, and then it sort of flattened out. Inflation's been slower since. So this is how we measure inflation, okay?
Okay.
The fact there's inflation means that everything I've taught you is wrong in one critical respect.
Yeah. Okay. Okay, so how to calculate I think okay, let me just do consumer price index. Let's just do that. It's a measure of inflation. Yeah. So I think it is just in the percent, right? Because like, yeah. Okay, so if we want, so using CPI rate to calculate price. Okay, just give me a basic. I don't want the AI summary. Okay. Oh, it's an indicator of inflation, right? Groups in the CPI basket and their weights in 2025. Oh. Interesting. Calculate inflation, an example. Okay. An example, we calculate inflation for a basket that has 2 items in the books and childcare. The formula for counting, yeah. Okay. Yeah. Okay. So, Okay. Okay, this is yeah, thank you, RBA. You know, this might have a lot of useful shit in it. In education. Monetary policy. This seems pretty sick. Because, like, this explanation is, like, exactly the level that I need. You know, real basic. This, we might have found a month or so of reading. How much is there actually here? Education, inflation, economics. Ah, I would like to understand what the RBA actually does, and how this actually seems awesome. This and got some videos as well, bro. Okay, this is sick. Okay. Hold on. Where am I gonna put this? This is our main study thing. Thinking, research, what? Okay. Economics. We need to do RBA. There's a lot of great stuff. That's awesome. Cool. Whoops. Did I? Oh. Hold on. Control Y. There we go. For more. RBA. But I'm definitely going to have like a whole separate note just for inflation. For sure. But yeah, very cool. Okay. Okay. Cool.
Which is everything I've taught you is about I, the interest rate. But that's not what you should care about. You don't care about what the interest rate is, what the nominal interest rate is. You don't care about how much money you have in the future. You care about how much good you can consume in the future. Money's just a means of exchange.
Yeah.
If I tell you in 20 years you'll have $100, you know what's that worth without knowing what stuff's going to cost in 20 years. What you really care about is your purchasing power. Okay? You really care about is your purchasing power. So for example, suppose today I'm going to save $100 at a 10% interest rate. $100 at a 10% interest rate. What I care about is not how much money I have next year, but how many goods I can buy next year. So let's say I'm like Marshawn Lynch and all I care about is Skittles. Okay, that's all I care about. Okay? And let's suppose that Skittles today are $1 a bag. So with my $100 today, I could buy 100 bags of Skittles.
Yeah, okay. Whoops.
Okay? So I could buy 100 bags today.
Oh, that's... I mispressed, but that opens up all the hotkeys. Oh, is this an alternate? Hold on. Where is that? Oh, no, that's there. If I do that. No, okay.
Now let's say the price of Skittles does not change, but I earn 10% interest. Then next year, I can buy 110 bags.
Yeah.
Next year. Right? The price of Skittles is still $1. I saved my $100 at 10%. I have $110, I can buy 110 bags. But let's say the price of Skittles has also gone up by 10%. How many bags can I buy next year? Someone tell me. If the price of Skittles gone up for $1, $1.10. Yeah. Back to 100. Back to 100 bags. So basically what I can buy is a function of the interest rate and prices. So what I care about is not the nominal interest rate, but what we call the real interest rate, which is the nominal interest rate minus inflation, which for some reason we denote by pi, even though pi is also profits. I don't know why we do that. We're a difficult profession. Okay?
Oh no.
minus call. So what I care about is not the nominal interest rate, but what we call the real interest rate, which is the nominal interest rate minus
Nominal interest rate. So nominal interest rate. Okay.
inflation, which for some reason we denote by pi, even though pi is also profits. I don't know.
Oh no. Oh no. Oh no. Um hold on. Oh,
Inflation.
Yeah, inflation. Oh no. Inflation. I'm gonna get confused by this for sure. Okay, we have a note here. Also used in pi is also used in this course to refer to profits. Unfortunately. Sad face. Okay. in economics.
Which for some reason we denote by pi, even though pi is also profits. I don't know why we do that. We're a difficult profession. Okay? So the real interest rate is the nominal interest rate minus inflation.
Yeah.
And that's what I care about. That's what I can buy. Is not the nominal interest rate, but the real interest rate determines what I can buy.
Yeah.
Now, this is a big topic of discussion in macroeconomics. In particular, a really fascinating point about this is that really this should be the expected inflation rate. Because I don't know what the inflation rate's going to be. When I put my money in the bank today, I know but I don't know what inflation's going to be. I know what it's been. I know what it's going to be. So if I say what's $100 worth in 20 years, you have to give me your expectation of inflation. So it's actually pretty complicated. And it goes back to things we've talked about, how people make decisions, and things we will talk about, how people think about these things, like how do you form expectations of inflation rate? It turns out there is a near perfect predictor of people's inflation rate expectations, which is what's happening to gas prices. Most people look at what's happening to gas prices, and based on that, they decide what inflation is going to be.
Interesting.
But the bottom line is,
Okay.
in theory, it's a very sophisticated. There are actually hundreds of thousands of people whose entire job, mostly work in financial sectors, but some working for the Federal Reserve, whose entire job is to form good expectations of this. That's their whole life, is to figure out what's inflation going to be and how does that affect decisions we're going to make.
So is there is there somewhere that like if there's hundreds of thousands of people who it's their job to do this, right? Are they posting the expected inflation rate over for the next month, couple of months, year, and whatever, and have that as a chart somewhere, and have their reasons why, and it's constantly getting updated? I guess inflation rate projections. Is does the RBA inflation rate projections? Outlook, monetary policy, peak. Let me see. Okay, so they've got 2026 May. But I would have hoped that there'd be. I guess it's too complicated to have a because a chart. Because maybe. Okay. Market conditions. Well, there's cash rate assumed in the forecast, also based on market price increases. No, that's cash rate. Inflation has been revised higher, while the direction of revision to the GDP growth in region varies. Domestic inflation was already elevated prior to the conflict. Okay. In the baseline forecast, the headline inflation, I don't know what headline here means, is expected to peak at 4.8%. Underlying trimmed mean. Okay, hopefully we'll understand all this after I do a deep dive into inflation. Okay, anyway, but yeah, so basically what we know is that yes, the RBA does publish like predictions and whatnot. Cool.
And it turns out to be a very hard and complicated calculation. But so that determines to be very, very important in thinking about what the real interest rate's going to be. Okay? Questions about that? Now, I'm going to go back, and sometimes I'll use R, sometimes I'll use I. The bottom line is what matters for real decision making is R. Okay, sometimes I use I because it's more convenient. But if ever I use I, it means I'm assuming inflation 0. Okay, so whenever I use I, I'm assuming inflation 0. I really should use R everywhere, so sometimes we slip back and forth. But basically, really should use R. That's a relevant decision making tool. Okay? Questions? Yeah. Awesome. Great question. And a whole field of research is what do you do about innovation? What do you do? So here's a perfect example. Imagine that there's a good that here's a great example. Let's take the laptop, which in 1990 was incredibly expensive and is now much, much cheaper. Okay? So basically, you would say, well, basically, life is cheaper now. But in fact, laptops do a ton more. How do we account for that? How do we really want to think about the price per unit of power? Not the price of a laptop, but the price.
Yeah. For innovation. Like, yeah. Is that a lot, or is a lot with no space fine? Okay, bruh. I feel like my whole life I've been spelling it without the space. A lot. A lot? A lot. Is it even a word? A lot. A lot? A lot is not a word. A lot. Oh my god. To a lot. It's not to a lot, but a lot. Damn. Okay. Oh, no.
Price per unit of doing stuff. Okay, that's gone down a ton more. The average laptop today is maybe half the price of the average laptop in 1990, but the average value of a laptop today is 100 times the average value of a laptop in 1990. We can do so many more things with it. The computing power is so much larger. That's not reflected in the typical CPI. So many people think we need to adjust the CPI for essentially what's happening to productivity. What's happening not just to the goods we buy, but what we can do with them. And that's a very difficult and interesting field. The clear conclusion is the CPI is too large. The growth rate of prices you hear every year is too large because we're missing the underlying innovations. That for the same price, you're getting a better good. You're missing that. And so as a result, when we say, gee, inflation went up 3%, you think, wow, it's 3% more expensive to live in America. That's not quite true. It's 3% more expensive to live in America by the same stuff, but you're getting better stuff. And that should be accounted for.
Yeah.
It's a good question. Other questions? Yeah?
I've been told sometimes that inflation is sometimes just a result of a healthy economy, and that if the economy is growing, there's going to be inflation that's going to be better.
Yeah, so now this is why I'll shake 1402, especially now. Right now in the last year, you've heard a lot about interest rates and inflation and things like that. So basically, I'm going to give you a 2-minute primer and we'll leave the rest of 1402. So 2-minute primers, go back to last lecture. Think about the market for capital. Okay, you've got the supply of capital on the x-axis, the price of capital, which is really, we now know, the real interest rate on the y-axis. You've got the supply of capital and the demand for capital, and some equilibrium interest rate, R star, and some equilibrium capital amount, K star. Okay? Now, where does the demand for capital come from? Let's start with supply. Where's supply of capital come from? Comes from people's savings. So as the interest rate goes up, people save more. What do they do less of? They consume less. So by raising the interest rate, you lower the amount of demand for spending, or you cool off the economy.
Right.
Likewise,
Right. Okay, so um so um so cooling off the economy just means decreasing consumption. Like there'll be less trades. Well, you couldn't say there are less trades happening. Maybe no.
What do firms do as the interest rate?
D. Can I not? Is that right? D. Incentive. Okay, whatever. That's a word.
Goes up.
It's a real word.
Of demand for spending, or you cool off the economy. Likewise, what do firms do as the interest rate goes up?
I mean, as the interest rate goes up for firms, the cost of capital is higher because they're needing to pay. Well, the interest rate is basically the rent price of capital, and so firms will want to invest less in capital, right? Because now it costs more. And so there's going to be less from the consumer side. There's going to be more incentive to save and less consumption, which also means that demand for the goods in the goods market that the firm is operating in, there'll be less demand for the good, which means that has an inward pressure. So that means that the supply should decrease. There's an incentive to supply less. And there's a incentive to not buy as much capital, right?
Well,
and so basically it slows everything down,
as the interest rate goes up,
right?
they spend less money building machines.
Yeah.
There's less demand.
Yeah. Raising interest rate. Yeah. From the yeah. How is this not a word? D. Is this not devise? Is it wanting me to use a Z there? Oh, it is. No, it isn't. What? What? Discourage, deters, de-incentivize. What's that here? I'm just gonna put it's gonna be de-incentivized, but discourage is
Demand
fine.
for
Okay. And then for for this is like people. It's not consumers, but it's like 'cause savings could come from anywhere. Like, could come from firms, could come from consumers. But really, it's okay. But okay, really, we're just gonna go for people, and then for firms, what are you gonna put? We're gonna put deters consumption, deters buying, deters capital investment, because, well, incentivize saving, because the future value of, of their savings increased. The total capital investment, because the cost of the capital is increased.
Investment. So they up. Well, as the interest rate goes up, they spend less money building machines. There's less demand for investment. So you cool off the economy. So the idea is, by rising interest rate, cools off the economy by lowering both the demand and supply of capital.
But like, what is the hotkey again? Is it this one? Yeah, here it is. Whoops. No. Ah, here. New window. Close. Ah, darn it. Okay. Here. So, whoops. Wish I could default it to the smallest one. So we've got real interest rate and capital, right? And then we've got, whoops, we've got capital here, capital. Then we've got R, whoops, I can't do a lowercase r. R, so this is current, R1, capital 1. We've got demand. Hold on. Okay, supply. Demand and supply. Oops. Yeah, because the demand is downward sloping. The demand for capital is downward sloping because over here we want a lot of demand. There's high demand when the interest rates are low. Okay, yeah. But low demand when the interest rate is high. Okay, I was just screwing myself a little bit. Okay, and yeah, supply is low when for capital is low when the interest rate is low, because there's less future value. Okay, and so, oops, I should have done it like this. Right, and so we've got, this is the current, oh my god, it's current equilibrium, right? And then we'll go to a different color. Blue. And then we've got R2. R2. Higher interest rate means lower demand. So we should have K2 here, right? That makes sense. But hold on, where's the... I'm doing something wrong here. The supply at... But at this interest rate, we're okay with the supply. Oh, right. Right, no, this is... Yeah. This has to be the equilibrium, because even though there's suppliers that would like to supply over here, well, they're limited by the demand. Okay. So this is right. I think. I mean, it makes sense. So there'll be less demand. Yeah, there'll be less demand as the interest rate is higher. And yeah, even though people are willing to supply at this amount because the demand's here. Okay. So hold on. But if we're limited by the demand anyway, what happens if there's an over... I mean, in this case, isn't there an oversupply of capital? Like, aren't we... because we're willing to supply way more at this interest rate. So... I don't understand. Because, like, say I'm willing to put $100, invest $100, right? But say I'm willing to invest $100 and at a 10% interest rate, but like where I've been investing in it doesn't want the entire $100 at that interest rate. So wouldn't that be an incentive for me to say, look, yeah, you can have the you can have like 50 at 10% and 50 at like 5%, or like wouldn't it be incentive for me to lower my... Oh, but this is the... Hold on. But this is real interest rate. Nominal interest rate, inflation. Like, am I not incentivized to lower the amount of inflation that I'm willing to accept? And so there would be just inward pressure. I'm missing something important. But anyway, what I was thinking of, it's my hand, was so this is capital, and so for a good in the goods market, where we have, cost and quantity. And we have C1, Q1. Right. If the because the people are spending, if they're able to invest, there's an incentive to invest more, right? So they're deterred from consuming now, which means that demand should lower. Shouldn't demand also move this way? Because they have less. Well, it might not even be that way, but basically we're lowering the budget constraint for the consumer. And so it's not just, so the higher interest rate doesn't just affect the capital market, but it also affects the goods market, because lower demand, which means that I don't know where it shifts. Does it shift this way? But anyway, there's going to be lower demand, the lower demand for the good, which then means that there'll be lower supply as well. I think this shifts this way. Anyway, I'm probably getting too far away. Oh, did I close? I closed everything. Did I? Hold on. Is this bugged? I think this is bugged. Uh-oh. Yep, good old. Okay. Close. Obsidian. There we go. Okay, close that. Great. Okay, we're getting too far away. Let's just keep going with the lecture. Too far away. Too far away.
Okay, and that's basically essentially why the Fed uses interest rate as a tool to fight that. That is.
Yeah. And so this is referred to as cooling off the economy.
Something you'll learn a lot more and a lot richer in 1402, but that's the basic deal for those of you who want to sort of understand the news at that level. Okay? Now, and obviously the tricky thing is how much you raise the interest rate, and that depends on this. Which is why there are hundreds of people, thousands of people probably employed at Feds around the country trying to figure out what this is, because that determines what they should do to set the right R star. Okay, now, let's go back to micro, and let's talk about choices over time. Let's talk about how individuals and firms make choices over time. Point 3, choices over time. Okay, so we're now equipped to ask the question, what do you do?
Do I want to save, should anything else here be super important? I think I want that, no, this is almost like a tangent. We'll get more into this when we actually look at. Well, yeah, this seems like, yeah, because I think he was answering a question. I think it's more in macro econ. Okay, that's fine.
When you face decisions that have different payouts at different periods of time.
I can always delete it later. Well, we'll add this to our important. But can I summarize this a little bit more? Yeah, and if I'm confused about why, if I forget why, then I can always just Control F it and come back.
And the answer is you just pick the payout with. Ask the question, what do you do when you face decisions that have different payouts at different periods of time?
Well, convert it
And
all
the
to
answer is you
present
just
value.
pick the payout with the highest present value. It doesn't matter when the money comes, as long as you put it in the same terms. So, for example,
Yeah. Yeah, I mean, that's, yeah. If I
consider
don't remember that from the previous, then that'll be kind of sad.
a professional athlete who's comparing two possible contracts. Contract A is $1 million today. Contract B is $500K today and $1.5 million in 10 years. Well, despite the Bobby Bonilla fun example, it's
The value of, in order to evaluate different choices of income streams at different periods of time, calculate their present each of calculate. Yeah.
it's not obvious which of these you should choose
Well, the
because they're
present
paid at different
value,
times.
Or future value, present or future. Like you basically, as long as you're putting each. Calculate the value at a specific time. Could be present or future. At the same.
So you add up and say, well, this is 2 million, this is 1 million, you should clearly choose
Yeah.
B, but that's not right because this is worth less because it's in the future. What you want to do is compare the present value of these two contracts.
I want this. Yeah.
Well, you know the present value of this contract is $1 million because you did it today. What's the present value of this contract? Well, the present value is going to be 500,000, 500K, plus 1.5 million, but you get it in 10 years. So you have to discount it. You put it over 1 plus R
Yeah.
to the 10th. That's the value that you'll have. So, for example, if the interest rate was 7%, if R equals 7%, then the value of this equation is 1.3 million. So at a 7% interest rate, you should choose option B. At a 14% interest rate, then it's worth 0.9 million. So at a 14% interest rate, choose option A. What's going on? Why does option B become less attractive as the interest rate goes up? Let me explain the intuition to me. You see the math there. Why does option B become, Exactly, at a 14% interest rate, if I had this money now, I'd get a ton of money 10 years from now.
Yeah.
Here I'm waiting 10 years to get the money. Money's worth a lot less in the future at a 14% interest rate. It's all about opportunity cost. The higher the interest rate, the higher the opportunity cost of getting money in the future relative to getting it today. Okay? So the key is basically you want money up front when there is a, you want money up front when you have a higher interest rate. You're happy to defer money when there's a lower interest rate. Okay?
And it's always referring to real interest rate here.
Now, so for example, let's go back to sports again. Let's talk about Max Scherzer. Max Scherzer, pitcher with the Washington Nationals. In 2015, he signed a 7-year, $210 million contract. The 10th biggest contract in history at the time. Okay? But it turned out the way the contract was signed, it was a 7-year contract, but it was paid out over 14 years. He only had to play for 7 years. But they'd pay him, instead of paying him $30 million a year, they're paying him $15 million for 14 years. He only had to play for 7. So the present value of that contract was not $210, but but more like $166 million. Now, why'd they do that? Well, for Max Scherzer's ego. Because if you look at the number 210 million, that was the second highest contract ever for a pitcher. Look at the present value of 166 million, it was like the fifth highest contract ever for a pitcher. So Max Scherzer couldn't go bragging he got the second highest contract ever for a pitcher if they just give him 166 million. So that's how come you're confused. Or more generally, let's think about the lottery. Okay, you see the Mega Millions is $1 billion. You think this is great, $1 billion, but you're not getting $1 billion. What you're getting is something like $33 million over the next 30 years. So the present value of Mega Millions is less than half of what's advertised. They don't hand you $1 billion today. They say we're going to give you $33 million over the next 30 years. The next 30 years. Still not bad. I mean, I take it, but a lot less than you think because it's paid out over time. Okay, so this determines the numbers you hear. When you hear a number from now on, whatever your number, you make the mistake of adding up numbers in the future period with today. You've got to recognize that's wrong, and you should be using the present value, which puts everything in today's terms, rather than falsely adding up future dollars with today's dollars. This doesn't just affect you. This affects firms' investment decisions. Firms' investment decisions. Okay? So for example, firms have a particularly interesting choice because firms have decisions where they sort of put aside money today to get money in the future. That's what investment is, right? So what firms consider when they make an investment decision is they consider what's the net present value of that investment, the NPV. What's the net?
But isn't it the same? Isn't it the same as just like calculating the present value or like the present value of all these different income streams?
Present value. So for example, consider from the stream of payments where you're going to get revenues in each period of R sub t and costs of C sub t. So you have a project where you get revenues of R sub t and costs of C sub t in every period. Mm-hmm. The net present value of that stream of payments is equal to R0 minus C0 plus R1 minus C1 over 1 plus R plus R2 minus C2 over 1 plus R squared, and so on. That's the net present value. This matters because cash flow is typically negative in the early years of an investment. Typical investment means R0 is less than C0. You're going to buy this big machine, you don't make that much money right away. But eventually you make the money. If you simply add it up and don't discount, investment will always look great. But if you recognize that investing a lot today might yield money in 20 years when it's worth less, it might not look as good. Okay? So basically, imagine, for example, you have a big upfront investment of $100 in year one with no revenues. So you have something where in year one you get it's $100 cost and no revenues. In year two, it's $200 in revenues and no costs. Well, you might think, gee, I'm sorry, year two you get $150 revenue and no costs. So year one, C0 is 100, C1 equals 0, R0 equals 0, R1 equals 150. Well, if you add these up, you'll say, gee, this is a great deal. It costs 100, I make 150. That's a great deal, but you know now that's not the right way to think about it.
Because you've got to, because you've got to discount the. Well, I mean, you could have made. Well, a few things like the $150 is worth less. Like dollar for dollar, it's worth less, and so you've got to convert the R1 value to R0. Do you also include, I guess, I mean, this would be too complicated, but I guess you'd also depreciate the value of the good as well, because you're consuming, like say you're buying a piece of machinery and it can last for 10 years, right? Then it's slowly losing its value, or is that, maybe that's outside the scope.
Okay.
So basically, as long as you're like, this is, you just got to like put all the revenue streams, calculate all into the same.
The interest rate is 10%. Then this formula at a 10% interest rate, this formula will say the NPV of this investment is $36.36. That'll be straight 10%. Oh.
Because it's right. Okay.
But as the interest rate goes up, eventually that will go negative. Stupid. Why? Because there's an opportunity cost of investing in the machine today, which is you could have put the money in the bank. Firms, just like people, have a decision to make about whether to invest today or in the future. As described a minute ago, talking about the macro stuff, the higher the interest rate, the less attractive investment today is. Why? Because they could put it in the bank instead. Firms always have the option, just like we do, putting the money in the bank. If the interest rate's 20% in the bank, that'll mean a pretty fucking good investment opportunity to give up 20% in the bank to go build a machine, to buy a machine. Because I'm giving up a huge rate of return on the money sitting in the bank. So essentially what drives firms' investment decisions is the NPV greater than 0.
Yeah. Yeah. Basically, I mean, it's basically the same, except now we're including the upfront cost. Um, and so yeah. Um. Which. Um. And that's where.
Firms invest if the
Yeah.
NPV is greater than 0. That's it. Simple rule. And all they need to know is what the revenues and costs will be, but also what the interest rate's going to be. Now, obviously, they need to know the future interest rate. So they need to know their expectations of interest rates. Okay? But in principle, in a world of perfect information, all they need to know is what the revenues will be, the costs will be, and the interest rates will be. And they can ask, then, is my money better off sitting in the bank or being invested in this good, in this machine? But that's the key point. Once you come back to the macro into which I gave a minute ago, the higher our interest rates, the less investment, because the more NPV is going to be driven below 0 by the upfront cost being today and the revenues you earn being in the future. Okay? Questions about that? So the bottom line is both consumers and firms face this. Indeed, consumers make investment decisions. Let me give a simple example. About 20 years ago, I had to decide whether to insulate my house. It's a very old house. Okay, at that point, I had heating bills of $2,000 a year. I had $2,000 a year heating bills on my house. Okay, and I decided, and the company that gives provides insulation said that by insulating my house, I could lower this by 25% forever. I could lower my insulation cost by heating cost by 25% forever if I insulated. But the cost of doing so would be $4,000. So I just did the NPV. I said, look, should I do it? What's the NPV? It's minus $4,000. That's my initial investment. Plus I save $500 the first year. 25% 2,000 plus 500. Okay? Plus 500 over the interest rate. Because I'm going to save $500 forever. That's the calculation. Negative in the first year. And then I'm going to get $500 forever from doing this. So what's the answer? The answer is as long as the interest rate was less than 12.5%, it made sense to do this. You can show that math to yourself. As long as the interest rate was less than 12.5%, it made sense to make this investment. But if it's above 12.5%, it no longer made sense to make this investment. Okay? So the bottom line is that it all depends on what else I could do with that $4,000. That's going to determine whether I should make this investment or not, and what my expectation of the interest rates are. So we all face these decisions all the time. Anytime we face a decision with a short-run cost and a long-run benefit, we should be doing the NPV calculation. The flip side is, anytime we face a decision with a short-run benefit and a long-term cost, we also do this. So when you decide whether to smoke, we'll talk about this in a few lectures in more detail, you should think about the short-term benefit, which is, you feel better, maybe if you're a smoker. And the long-term cost is you die sooner, but you die sooner off in the future. So you got to decide what's that worth. You have to discount it. This is true. So every example says you have to weight the present and the future differently to add them up and think about the decisions you make today. Okay? Questions about that? Yeah. It should always be R. What do I use I? Oh, yeah, it should be R. Sorry. Okay? Okay, for those of you who check my math at home, actually the 12.5% comes from an example where we don't get benefits the first year. So the example gave me 12.5% makes math easy. I assume the insulation doesn't start working until year 2. Okay, just so in case you're gonna check my math. Okay, but the intuition's the same. Now, let's go to one last example. You guys, it's like, geez, I'm thinking about professional athletes and retirement insulating my house. Like, this is so irrelevant to me. Let's go to an example that's totally relevant to you. Or at least was to you 4 or 5 years ago. Should you go to college? It's a pretty relevant decision to a lot of people in America. Well, this is a decision, an investment decision over what we call, we've talked so far about machines and investing in capital. This is what we call investment decision in terms of human capital. All the time, we make decisions about how much to invest in ourselves. Every time we decide to go to college or decide to get any other training or learn a new thing, we're investing in our human capital. We're building our productivity. If the new thing's sports, you're not building productivity. My wife constantly tells me. But if the new thing, something's actually productive for your job, you are building your productivity. You're investing in your human capital. Okay? So for example, let's imagine, let's go to figure 72, we're going to do an example. Imagine that when you graduate, your decision when you graduate from high school is to go to college or not. If you don't go to college, you work from age 18 to age 70. If you do go to college, you work from age 22 to age 70. Okay? Now, if you go to college, okay, there's 2 costs that you get if you don't go to college, that you add relative to college. First of all, you got to pay for college. So during the 4 years that you're in college, that green area, you're paying tuition. That's why it's negative. But there's a second piece. What's the other opportunity cost of college? Yeah. You could be working. That's a real cost, just like tuition. You all could be out there earning money right now. So you're sitting here. The opportunity cost of this lecture is the money you all could be out making real money. Okay? There's an opportunity cost. You are, for those 4 years, not only paying tuition, you're foregoing the opportunity cost. That is a huge benefit to not going to college. However, if you graduate, once you graduate college, not if once you graduate college, you earn more. So you get more money for the rest of your life by being a college graduate. That is shown after year 4 in the yellow part of the graph. Andrew, I think we can draw this a little more neatly next time. It looks like a preschooler drew it. Looks like or me. So we can draw this a little more neatly next time. Basically, the idea is beyond year 4, there's some net benefit. Okay? The net benefit is how much you get from earning more because you got a college degree relative to just having a high school degree. Okay? And that is the yellow area. So if you decide whether to go to college, you basically need to think about what is the cost and benefits. Well, that's going to depend on the interest rate. So for example, if the interest rate's 0, then the NPV of college is shown on the table at the bottom. The NPV of college is way above the NPV of just dropping and going to high school. You should definitely go to college. But once the interest rate gets above 3.5, okay, then, I'm sorry, the interest rate is, I know that 3.5 is weird. Yeah, ignore that 3.5. I know what that's doing there. That's weird. That's just, I think that should be maybe 1 or something. I don't know what's going on there. We'll fix that. Ignore the 3.5. At 2%, you should still go to college. At 4%, you should still go to college. At 6%, you should go to college. But once you get to 8%, it breaks even. At interest rate of 8%, you are literally financially indifferent between going to college and not going to college. And what's above 8%, you lose money by going to college. It's phenomenal, right? College graduates earn a ton more than high school graduates. And yet, through the power of compounding, you actually lose money by going to college once interest rates are above 8%. It's pretty phenomenal. That is why one of the major interventions the U.S. government does to try to increase college attendance is student loans at a subsidized interest rate. One of the ways we try to encourage people to go to college is by giving them subsidized loans at a lower rate to make this a better deal. Okay, and that's why that can be a very powerful tool to get people to go to college. Okay, questions about that? All right, we'll stop there, and we'll come back next time talking about uncertainty.
Very cool. Trade. Very, very, very cool. Big choices over time.
Today we're turning to a new topic. Remember, starting the topics part of the course now. We talked about factor markets and things like investing decisions and interest rates and things like that. Now we're going to come to a new part.
Okay.
Of the course, which is talking about international trade. International trade is one of the central issues in all of economics. As with every topic we cover in this course, we won't do enough justice. We'll just do 2 lectures. But if you find it interesting, we have an entire course called 1454, which is all about international trade. So this will give you a taste of how we can apply the tools of basic microeconomics to important questions, one of which is trade. Now here's a question for y'all. How many of you have ever given or received roses on Valentine's Day? Just to your loved ones. On the other hand, all the guys who had jobs producing roses have lost their jobs. There were presumably hundreds, not thousands of jobs. There were presumably hundreds, not thousands of people involved in growing these roses in the U.S. They're not out of work. Please get them from Colombia.
This
is
debate
loading?
over the fact that consumers get goods cheaper, but producers lose their jobs is the heart of the debate over international trade. Okay? This is a particularly important topic right now because traditionally, the divide over international trade, as I mentioned when I talked about voluntary export restraints, was traditionally broke down along party lines, with Republicans favoring free trade and Democrats opposing free trade. That sort of reversed over the last several decades. The largest free trade initiative of the last 50 years was Bill Clinton's NAFTA, a Democrats bill, the North
NAFTA? North American Free Trade Agreement. Agreement signed by Canada, Mexico, and the US. They created a trilateral trade bloc in North America. Trade bloc is a type of intergovernmental agreement, often part of a regional intergovernmental organization where barriers to trade, tariffs, and others are reduced or eliminated. Okay. The agreement came into force in 1994, superseded the Canada-US free. Okay. Passage of NAFTA resulted in the elimination or reduction of barriers to trade and investment between the US, Canada, and Mexico. The effects of the agreement regarding issues such as employment, the environment, and economic growth have been the subject of political disputes. Most economic analysis indicated that NAFTA was beneficial to North American economies and the average citizen. NAFTA economic impact. These are the types of papers that I'm like doing the course to hopefully eventually be able to like understand. Well, this is an article, foreign relations. Anyway, okay, we got to focus.
American Free Trade Agreement, which opened up trade between the U.S., Mexico, and Canada on a very free basis. And the biggest opponent of free trade in the Oval Office in the last 50 years was Donald Trump, who used tools of trade to go after China, to declare sort of economic war of China in particular. Donald Trump imposed a tariff, which is a tax on imported goods from China.
Tariff. Tax.
So in fact, parties reversed. Now it turns out basically now we're in a situation where everybody's against free trade. Indeed, President Biden.
But there were two F's in tariff. 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 I thought it was tariff. Trade. Trade. Tariff. Two F's. Tariff.
Biden has kept in a lot of the Trump anti-trade practices that were in place. Free trade is very unpopular right now. Okay? Now, the extent to which countries participate in international trade is described by two quantities. There's exports. Those are goods produced domestically, but consumed abroad. And there's imports, which are goods produced abroad and consumed domestically. So exports are goods that a country sells to the rest of the world. Imports are goods a country buys from the rest of the world. Currently in the U.S., we have about $2 trillion worth of exports. We currently export about $2 trillion worth of goods, and we import about $3.2 trillion. So exports are $2 trillion, imports are $3.2 trillion. The difference, imports minus exports, we call.
So we'll do like in goods.
Call the trade deficit.
Okay.
So we have a
import minus exports. Oops. Of 1.2?
$1.2 trillion.
Okay, therefore 1.2 trillion trade deficit.
Trade deficit.
There's a trade deficit, and there's also what was the other one? Trade. Maybe I'm confusing it with budget deficit, and there's two budget things. Budget deficit versus there's the debt, right? Debt. National debt versus, because one of it is like the total amount, and one of them is what it is for the year, I think. Debt, deficit, debt, international comparisons. This is a little bit of a tangent, but I just wanted to remember. Australian government debt is the amount owed by the Australian federal government okay, so there's debt. So 928 billion in debt, a share of GDP. Ooh. Not that I really know what GDP is yet. That'll be later. But then the deficit. But then national budget deficit wiki. I wonder if wiki has a thing on deficit spending. Deficit spending is the amount by which spending exceeds revenue over a particular period of time. Oh, right. Simply deficit. Budget deficit. Oops, a budget surplus. Oh, okay. Okay. So when you say reduce the deficit, we're just talking about for a particular period of time where reducing how much we're spending and getting closer to spending, or getting closer to a surplus, basically. Well, like getting close to zero by reducing the deficit. And deficit spending. The mainstream economics position is that deficit spending is desirable and necessary as part of counter-cyclical fiscal policy. But there should not be a structural deficit, i.e. permanent deficit. The government should run deficits during recessions to compensate for the shortfall. Should run surpluses in boom times so that there's no net deficit. Right. So you run a deficit so that you don't to alleviate some of the ways that a recession is going to screw your economy. Oh, anyway, cool. Okay, I just wanted to double check a few things, but
that means we import about $1.2 trillion more worth of goods than we export. This was a large focus of the Trump presidency and of many politicians. As a sign, it was viewed as a sign of U.S. weakness that we have this giant trade deficit with other countries. They were exporting quite more than they were importing. But in fact, that intuition is completely wrong. And to see why, let's start with a simple example. Okay, suppose you and your best friend both love Pokemon. And you love all the Pokemon equally. You want to collect them all. Okay, you got to catch them all. You love all the Pokemon equally. You love Pokemon, your friend loves Pokemon, and you value them all pretty equally. So let's say that you have 2 Pikachus and your friend has 2 Jigglypuffs. And let's say you and your friend think Pikachus and Jigglypuffs are pretty much worth the same thing. I'm not a Pokemon aficionado enough to know if that's true, but let's say they're roughly worth the same thing. So let's say you go to your friend and say, look, I have 2 Pikachus, you have 2 Jigglypuffs. I'm going to trade you 1 Pikachu for 1 Jigglypuff. And your friend says, yeah, that's great. I'd love that deal. I don't have any Pikachus. So you make the trade, and you go from 2 Pikachus and no Jigglypuffs to 1 Pikachu and 1 Jigglypuff. And your friend goes from 2 Jigglypuffs and no Pikachus to 1 Jigglypuff and 1 Pikachu. Now, what you've just done is created a Pikachu trade deficit. Think about it. You used to have 2 Pikachus. You've just created a Jigglypuff trade deficit. You've just imported 1 Jigglypuff, and you've exported 0 Jigglypuffs. So you've created a Jigglypuff trade deficit. You could see, presidents ranting about the Jigglypuff trade deficit. America will always be a second-class nation as long as we have a Jigglypuff trade deficit. You might say, well, that's silly. And you'd be right, that is silly. But it's no sillier than worrying about the general trade deficit. Indeed, let's just imagine we replaced you with the United States, your friend with Colombia, Pikachus with dollars, and Jigglypuffs with roses. Then we just made the same trade. We just sent them dollars to buy roses. It made us better off because we wanted the roses. It made Colombia better off because they want our dollars. So who lost? No one lost. It was just a trade that made both sides better off, which is what trading does.
So really, one of the more important figures might be like the volume of trade. Because like, if we assume that like all prior to in the course, basically more trades are better. Well, I mean, often more trades are better because, we well, no, let me rephrase. We want all trades that can happen, like where there are, buyers willing to buy at a price and sellers willing to sell. We want all trades that can happen in general to happen. And so like the volume of of how many trades there are between a country is more indicative of like is more interesting than however much one, like whoever is importing or exporting.
We've created a deficit with Colombia, but only because the deficit is measured in dollars, not in welfare. Yes, we have a trade deficit, but we also have a rose surplus. Okay?
Yeah.
And just like we don't care about Jigglypuff deficits versus Pikachu surpluses, we don't really care about dollar deficits versus goods surpluses. Okay? We're happy to make this trade, and indeed, blocking this trade would lower social welfare. For the same reasons that blocking any trade where the marginal benefits exceed the marginal cost lowers social welfare. Okay? That's a fundamental intuition of the first fundamental law of welfare economics, which is that basically anytime there's a trade where the marginal benefits exceed the marginal costs, you should allow that trade to be made. If you don't, welfare is lower. And that, in a nutshell, is why economists support free trade. That's it.
And this is, this is fine to rewrite, but like, what? No, we don't need that.
And we'll go through the math and stuff like that through this lecture. But that's really the intuition, is that economists support free trade because if there's a trade that both parties want to make, we should let it happen. Okay? Now, of course, this is much more complicated in reality. One complication arises because of the issue we've just been discussing in the last few lectures, which is market failures. Trades only make both parties better off if you're in a perfectly competitive market. If not, they might not make both parties better off. Another issue is that we might care differently about winners and losers. Remember, I've discussed in this class how the classic definition of social welfare simply adds up producer-consumer surplus.
Yeah.
We said that has some nasty implications, like, for example, we're totally indifferent between a perfectly competitive outcome and a perfectly price-discriminating monopolist outcome. We're perfectly indifferent between consumers getting some surplus and consumers getting no surplus. That doesn't feel right. Likewise, we might not be indifferent between people getting cheaper roses and other people losing their jobs. Okay?
What am I writing? Oh, we care yeah, we care. We care that the consumer and producer surplus isn't all on one side. And yeah, we might care about yeah, like protect. Would this be like this other things, other like protecting protecting jobs?
And as a result, the standard model might not work in reality. But it's important to understand the standard model first. It's important to understand why economists favor free trade. And then we can talk about, in the real world, why there might be rationales for opposing it. Okay? So that's the setup for what we want to talk about, international trade. I'm then going to understand international trade, I'm going to introduce a new tool into our toolkit, which is the Production Possibilities Frontier, the PPF. The Production Possibilities Frontier. The Production Possibilities Frontier is going to introduce a new concept. We've talked about economies of scale. Economies of scale is the idea if you get twice as big, do you produce twice as much? Now we're talking about a new concept, economies of scope. Economies of scope are relevant when you, the firm, produces multiple different goods. An economy of scope arises when producing one good makes you more productive at producing the other good. An economy of scope arises when producing one good makes you more productive at producing the other good.
Like pigs and fertilizer, maybe. Like if you were, if you had a huge pig meat export market, well, because you have all the manure and whatnot, is that what is meant? I mean, like, the assumption being that it's going to be cheaper to use a byproduct of your primary good to produce of good one to produce good two, as opposed to buying in that. But I don't know if that's quite what is meant by more productive.
A diseconomy of scope arises when producing one good makes you work.
An economy. A diseconomy of scope. Let me go economy of scope. Bold. When producing
worse at producing the other good. And we illustrate this, economies of scope or diseconomy of scope, through a production possibility frontier. As an example, let's go to figure 18.1.
Point on exams. PPF.
It's your figure 18.1a. Okay.
Hold on. Is there an easier way? If I go to the right, new tab. Good new tab.
Here we have an economy of scope. So let's think of a simple example. As always, it's good, easier with two goods. Let's think of yourself as the firm. You're the firm and you produce two things. You produce exams and problem sets. Okay? That's what you do. You're producing, that's life at MIT, right? Your firm at MIT produces exams and problem sets. That's your life for 4 years.
I'm going to get a coffee. I'll be right back. Is there anything that I wanted to... That trade deficit... Isn't intrinsic. Wait. Isn't intrinsically it's like in of itself, right? Isn't because we need to look at like, because you could have a large trade deficit with that, well, that is producing that is resulting in things that we care about, in like that is hurting things that we care about, or not, or you know, it could be helping. Like, it's intrinsically good or bad. Basically, more complicated. See below. Free trade. Free trade. Okay, anyway, I'll be right back. Coffee time? Coffee time? Yes, coffee time. Let me do... Hold on. Okay.
Okay?
Let's
Now,
continue.
imagine that you have a certain amount of inputs. Now, obviously, you can vary your inputs, and that could lead to economies of scale. Twice as much time studying could double your score, or it could less than double your score. That's economies of scale. Okay? But now I'm saying let's hold the time constant. Let's say a certain amount of time you want to spend studying. Now the question isn't how much time you spend studying, which is the economies of scale question, but how you devote your time, which is the economy of scope question. And let's say, for example, that the course has 10 problem sets worth 20 points each, or one exam worth 200 points. That's the way the grading in this course works. And your goal is to get the best possible grade. Well, you can decide how to devote your time between working on problem sets and studying for the exam. Imagine it's multiple exams worth 200 to make it a little more continuous. Okay, there's multiple exams worth 200 points total. So you can decide how to devote your time between throughout the semester by working on problem sets or studying for the exam. So let's say, for example, you decide you're going to spend all your time studying for the exam and none working on problem sets. Then you're at the x-intercept in the linear PBF. You get a perfect score in the exam, but 0 on problem sets. Likewise, if you decide to spend all your time on problem sets, you might get a perfect score on problem sets, but you'll get 0 on the exam. Okay? The question, we've drawn the first graph as it's linear. Literally, it's an equal trade-off. Every point you give up on an exam, you get in a problem set. But in fact, there's strong reasons to believe that there'd be economies of scope between doing problem sets and how you do the exam. Or between studying for exam and doing the problem sets, because it's the same work. The more time.
So it would be linear if they were like completely different subjects, right? But, you know, because in a course you would expect that there's going to be material crossover. Okay. Basically, producing one good means producing basically would you write it as DQ good one? No. Basically like producing one good reduces your production of the other good. Whereas oops, scope. Yeah, well, actually, why am I just rewriting? Okay, why am I just rewriting what's above here? But anyway, so in here, linear PPF, do I even need to write this? No, I get it.
Time you
Well, like, it would be like, choice, well, study for problem. Oh, hold on. Set points of problem set. Well, study for problem sets, points and exams. Is this right? Points and problem sets. Shouldn't it be study for problem sets, study for exams? Well, it should be just points and problem sets. No, it should be study for exams. Well, it should be study for either, and then with the assumption being the more you study, the more points you get, and then there's crossover, right? I think that labels are a little bit off, but anyway, this is how I understand it. But yeah, study for problem sets, study for exam, and because the course material is likely to overlaps between the two. By studying for one will make you better at the other. Therefore, your time,
Spend on problem sets, the better you might do in exams. The more time you spend studying for exams, the better you might do on problem sets.
Yeah.
That would lead to an economy of scope and an outward bending PPF. Okay? That would lead you on scope, and basically you'd have a.
What would be a diseconomy of scope in this example? What if the two choices are well, I mean, if the two choices are consumption of alcohol and studying, but that doesn't, yeah. But no. What about something like I was thinking like if you're doing a work that makes you too sleepy to study. I don't know if that, but then you could say energy is what your whatever.
Convex production possibilities frontier. The convex production possibilities frontier arises when it's more
Well, need to do something. Make a note. I'm recording my calorie intake. I feel like the pairs I'm eating are small. Average pair size. 2 inches. I feel like I have small pairs. Average pair calories. I could weigh them, but like I have a large variety of pair sizes. Be annoying. 53. Why do I have 101 written here per pair? $101 just seems like a lot. 101. Maybe this is where I got it from. Medium pair. I think my pairs are teeny. I think they're small. I think these are some small ass pairs. They're like 2/3 the size of my normal pairs. Okay, I'm gonna reduce it a little bit.
efficient to produce goods jointly than it is to produce them separately. So
Let me go back.
arises when it's more efficient to produce goods jointly
Yeah.
than it is to produce them separately. So it's
Yeah. Two goods.
arises
Yeah, jointly.
when it's more efficient to produce goods jointly than it is to produce them separately. So it's ever more efficient to produce goods jointly than separately, then that will give you.
I wonder if, like, I wonder if there's like a good, like, if there are goods where there are like waste heat produced, and you can use that heat for something, for producing another good. But I wonder if that seems like a different thing, because like, I feel like that's a different question where that's like, you're recycling the waste of producing one good to produce another. Seems like a different question of this, because like this is, you're not reusing the waste of studying on problem sets. It's like it's directly making you better on the exam.
The convex
Anyway,
production
he'll get to
possibility frontier.
examples.
We call that an economy of scope. Okay? It's more efficient to do stuff together than do them separately. Questions about that? Now, you can also get diseconomies of scope. Okay? That would be illustrated in figure 18.1b. That would be a concave.
Points. I want to see how. Yeah, I don't get this one.
Production possibility frontier, where literally you're better off doing one or the other, but the combination of the two makes you worse. Now, it's hard to see that in our example. Let me give you an real-world example of this, which is when I was an MIT undergraduate, I was a pretty good tennis player. I was on the MIT tennis team, JV. Okay, it wasn't great, but I was on the tennis team. Okay, but I'd never tried squash before. And people said, you're a college, you're an elitist East Coaster, you got to play squash. Okay, so I decided, fine, I'll go try squash. Well, it turns out tennis is all about not using your wrist, and squash is about using your wrist.
Right.
Tennis, you're about trading that ball flat. Squash, you're about sort of slicing it and hitting it using your wrist. And it turned out the more I played squash, the more it screwed up my tennis game. And the more I played tennis, the more it screwed up my squash game. That was a diseconomy of scope, if I can use such a sort of an elitist example of a diseconomy of scope. Okay? Where doing one made me worse at the other one. Okay? So both things can be true. You can have both economies of scope and diseconomies of scope in your production possibility frontier. Questions about that? Okay. With that in mind, now we want to turn to our
trade deficit, free trade. Yeah. Let me just put this here. Scope. And
classic model of trade. We're going to talk about, this is really one topic. Sorry, I wrote this with a thin chalk. It's hard to see. Comparative advantage and models of trade.
Comparative.
So we're going to turn to the topic of comparative advantage and trade. Okay. Now, the way we think about international trade in convenient ways, we use what's called 2x2 models. This is the workhorse of international trade. If you take 1454, this is where you'll start. 1454. 2x2 trade models. Two countries with two goods. There's no money in these models. It's two countries, two goods. So let's, for example, imagine our two countries are the US and Colombia, and our two goods are roses and computers. So imagine a world with just two goods in them, roses and computers, and just two countries that produce those goods, the US and Colombia. The idea is, Colombia, it is relatively easy to grow roses because the weather conditions are such. But in the US, it's relatively easy to make computers because we have highly skilled workers. So that's the setup of the model. So we're going to put particular examples on it. Here's a particular example. This is the way a 2x2 model looks. So for example, let's say we have two goods. We have roses and computers. Let's say we're talking about a dozen roses versus a computer. Okay, so this is a dozen roses versus a computer. Okay? And then we have Colombia
Oh, okay.
and the US.
Okay, let's just make this table. Oops.
Okay? And let's say that the only input to producing these goods is labor. Obviously,
Okay.
untrue, certainly with computers. There's a lot of capital involved. But once again, we're going to start with this easy model. Two goods, two countries, one input. Obviously, all those numbers can expand. You can have two goods, two countries, 6 inputs, or 6 countries, 8 goods, 4 inputs. Anything can go on. But life can be easiest if you have 2 countries, 2 goods, 1 input. The input is labor. And that input produces, we're going to have a constant returns to scale model, where basically we're going to simply say that to produce 1 carton of roses in Colombia takes 1 worker, okay? Takes 1 worker, okay? I'm sorry, takes 1 hour of labor. These are hours of labor. So there's 1 carton of roses in Colombia, takes 1 hour of labor.
Okay. Oops.
Produce 1 computer takes 8 hours of labor.
Okay.
In the US, to produce 1 carton of roses takes
So these are, hold on, let me just put here. Why can't I just, oh my God. Oh my goodness. Why can't I just have the star without, whatever.
2 hours of labor, and to produce 1 carton and 1 computer takes 3 hours of labor.
Okay.
Now, based on these numbers, we can draw the PPFs for the US and for Colombia. And they're going to be linear. I haven't put any economies of scope in here. I've just made them linear. So if you look at figure 18.2,
Why can't I get rid of this gap here? Darn. Okay, PPF for Colombia. Cartons of roses. Slope -8. Okay, so their budget constraint is basically 24. Okay, so 24-hour budget constraint. They can make 24 roses or 3 computers. 12 cartons of roses or 8 computers. Okay. 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 Okay.
here are the PPFs for Colombia and the US. In a given day, if we think of a budget of 24 hours, so imagine we're going to do the PPS for a given, remember PPS are about for a given set of inputs. Here's
Right,
inputs
for
going
a
to be
day.
24 hours of labor. Before it was a certain amount of time you had studying. Now it's 24 hours of labor. For a given set of inputs, which is 24 hours of labor, what can we produce? Well, in Colombia, with 24 hours of labor, we could produce 24 cartons of roses or 3 computers or some combination of the two. In the US, we could have 12 cartons of roses or 8 computers or some combination in between. The line connecting those is the PPF. The P
Oh.
or 3 computers or some combination of the two. In the US, we could have 12 cartons of roses or 8 computers or some combination in between. The line connecting those is the PPF.
Okay.
The PPF shows you the combinations you can have for a given level of inputs. And in our example,
Red line equals PPF. And this was a production possibilities frontier. Oh, this is okay. I was overthinking. It's just like, yeah, what you can reduce. I'll just write it again. Production possibilities frontier. Basically, the options the country has to produce. Yeah.
Example is linear, just to make life easy.
Well, the option. Okay.
You could obviously make it more complicated with economies of scope, but it's economies of scope, but it's easiest if it's linear. So you've got these simple linear production processes.
Yeah.
One input, constant marginal cost. Okay, it's just literally constant marginal product of labor. Constant marginal product of labor. Literally, every time you want to produce another rose, it takes 1 unit of labor in Colombia, 2 in the US. Okay, so lots of assumptions floating around here. Constant marginal product of labor, 1 input, 2 countries, 2 goods. Okay? Questions about that? Let me pause. This is a hard but important model. Let me see if there's questions about how this is set up. Okay. Now, we want to ask, who has the advantage in producing these goods? And the way we want to ask it is through the lens of comparative advantage. That is, we don't want to ask who's better at it. We want to ask who's relatively better at it. So, for example, who has the comparative advantage in roses? Well,
Yeah, that's it.
Colombia, to answer this question, we go back to opportunity cost. And the reason we think of things in relative terms is because then we can express the opportunity cost mathematically. What is the opportunity cost of producing a box of roses in Colombia? What do you have to give up?
An eighth of a computer.
To get a box of roses in Colombia, what do you give up? Yeah. What? 1 hour. But what does that give up? But it's all the hour time. Yeah. In Colombia, you give up 1/8 of a computer. That's exactly right. So it's time. Okay, I love the celebration. You got the answers right. That's good. You celebrate that. You're doing a great job. Okay. So in Colombia,
I wonder if we can hear the celebration. Hold on.
in Colombia, you give up 1/8 of a computer. That's exactly right. So it's time. Okay, I love the celebration. You got the answers right. That's good. You celebrate that. You're doing a great job. Okay.
There's a couple of moments like that. I want to save this one. It's really lovely how he encourages questions and stuff and rewards.
And the reason we think of things in relative terms is because then we can producing a box of roses give up. Yeah.
Because there's another point. I've got to find it.
What?
It's fun.
1 hour. But what does that
I'll
give up?
save this
But it's
one.
all the hour time. Yeah.
Here. Put this here. $22.35.
In Colombia, you give up 1/8 of a computer. That's exactly right. So it's time. Okay, I love the celebration. You got the answers right. That's good. You celebrate that. You're doing a great job. Okay, so in Colombia, the opportunity cost of a box of roses, which takes an hour, is 1/8 of a computer, which also takes an hour. In the U.S., now let's first say that's an hour. What's the opportunity cost of a box of roses?
In the US, the opportunity cost of a box of roses is, well, 2/3 of a computer.
2/3 of a computer. Okay.
Right. So, okay. Colombia.
Okay? So the opportunity cost of a box of roses in Colombia, the opportunity cost of a box of roses in Colombia is 1/8 of a computer. The opportunity cost of a box of roses in the US is 2/3 of a computer. So what we say is, since Colombia has a lower opportunity cost, they have a comparative advantage in roses. Colombia has a comparative advantage in rose production. Why? Because the opportunity cost is relatively lower. Flipping that, okay, so let me stop there. So Colombia has a comparative advantage in roses. Now, let me be clear for a second. I want to distinguish comparative advantage from just the term advantage, or what we call absolute advantage. I want to distinguish those. And the best way to distinguish those is, of course, to think about LeBron James mowing his lawn. Okay? Let's think about LeBron James mowing his lawn. Now, LeBron James does two things: play basketball and mow his lawn. Okay? And let's assert LeBron James is better than anyone in the world at both playing basketball and mowing his lawn. LeBron James being awesome. I mean, the guy's built, right? He just crank on that lawn. Okay, so let's assert LeBron James is the best person at both mowing his lawn and playing basketball. He has an absolute advantage in both activities. But he has a comparative advantage in playing basketball. In other words, he's way better. Let's take LeBron James versus me. Now there's two goods, playing basketball and mowing lawns, in two countries, LeBron James and Gruber. Okay? LeBron James has a massive comparative advantage in playing basketball. I suck at basketball. Okay, he has a billion to one comparative advantage in playing basketball. Mowing lawns, he's maybe 5 to 1. He's certainly better than me at mowing a lawn, but is he more than 5 times? Could he do it 5 times faster than me? Probably not. So LeBron James has an absolute advantage over me in basketball and lawn mowing. But his comparative advantage is basketball. LeBron James should, and this will be the hint of where we're going, LeBron James should specialize in basketball, let me mow the lawn. Now, in fact, I shouldn't mow the lawn either. Because let's take me versus a landscape contractor, and let's do economics and lawn mowing. I am certainly better than the average landscape contractor at economics. I'm probably worse at lawn mowing. So I should then hire the landscape contractor. It's all about comparative advantage. It's what are you relatively better at? Okay? Now, let's go back to another example. Who has the comparative advantage in computers and why? Which country has a comparative advantage in computers and why?
Well, obviously the US, but in terms of this, so the opportunity cost of producing a computer is 8 roses for Colombia. The opportunity cost for the US is 2 and 1/2. 2.5? 2.5. 8? What? 8? And so hold on, my brain is blanking. And so the US has comparative advantage because they have a lower opportunity cost.
Which of these two countries has the comparative advantage of computers and why? Yeah. Right, so what's the opportunity cost of a computer in the US? Yeah, go ahead. 3/2. For computers, this is roses. For computers, the US opportunity cost is 3/2.
Right.
What's the opportunity cost in Colombia?
1 point. Okay.
8.
My brain was screwing.
So the
Screwing with me.
U.S. has a comparative advantage in computers.
Yeah.
A lower, give him the fist bump, go ahead. The lower opportunity cost in computers. Advantage in computers. A lower, give him the fist bump, go ahead. The lower opportunity cost in comparative.
That's fun.
For computers, the U.S. opportunity cost is
Hold on, I want to say
3 halves. What's the opportunity cost in Colombia? Eight. So the U.S. has a comparative advantage in computers. A lower, give him the fist bump, go ahead. The lower opportunity cost in computers. The U.S. has a comparative advantage in computers. Okay? So in this model, Colombia has the comparative advantage in roses. The U.S. has the comparative advantage in computers. Okay? Now, let's go back. Now let's add one more wrinkle to this example. I've already made it simple enough. I've said, look, constant marginal product of labor. Okay, one input. Now let's go further. Let's imagine these goods are in perfectly competitive markets. Let's imagine the goods are in
It would have been interesting to go through an example where one, like the LeBron example, LeBron has an absolute advantage in both, but a comparative advantage in one. Whereas here, one side has a comparative and absolute advantage. Colombia has a comparative and absolute advantage in roses, and the US has a comparative and absolute advantage in computers. But it would be interesting to say, to have the example be the US having an absolute advantage in both, right? Because to distinguish to illustrate why it's important to look at comparative rather than absolute advantage. But
bought in perfectly competitive markets.
What did you say?
Are perfectly competitive markets.
Okay.
Let's imagine the goods are bought in perfectly competitive markets. And let's start with a simple example of what we'll call, sort of a weird word, but I don't know why we use it. We call it autarky. Autarky. A-U-T-A-R-K-Y. Autarky. It simply means no trade. I don't know why we use that fancy word. Okay? But basically, this is the secret to why economists are successful and wealthy, is that we make up fancy words for really easy concepts. It makes us sound smart. So we call it autarky. But it just means there's no trade. Okay, in a world of autarky, each country has to produce its own computers and roses. Now let's ask, in a competitive market, let's say there's a competitive market for goods and for labor, and the wage rate is W. The wage rate in this competitive market is W. Okay? Now, you can then tell me, and let's say W is the same in both countries. There's a wage rate W. You can tell me what price roses will sell at in the US. At what price will roses sell in a perfectly competitive rose market, with a perfectly competitive labor market and a wage W? What will be the price?
Well, but if there's no trade in autarky, it would just be whatever the price is for the US market.
For roses in the US.
Right, because it's not
what is
Colombia.
price equal in perfect competition? So raise your hand and tell me. Yeah. Marginal cost. What's the marginal cost?
Oh.
2W. So we know that roses, the price
right, because it takes 2 hours of waging. Yeah.
in the US will simply be 2W. We're done.
Yeah.
All I had to give you was this.
Yeah.
And you could tell me the price. We know the price
for computers in the US will be 3W. We know the price of roses in Colombia will be 1W. And we know the price, that's roses, I'm sorry. Yeah, roses in Colombia. The price of computers in Colombia will be 8W. We know all the prices.
Yeah.
Simply because we know under perfect competition, okay, we know under perfect competition how prices relate to marginal costs. Okay? So basically, in the US, if you cannot trade, then in the US, computers will cost 1.5 times as much as roses. The price of a computer 1.5 times the price of roses. In Colombia, a computer will cost 8 times as much as a rose. So if you can't trade, we know what the market's going to look like in each of these countries. Okay? We know what the market's going to look like in each of these countries. So now, let's imagine that we actually allow trade. Well, if you allow trade, here's the miraculous piece. By allowing trade, you create economies of scope. Allowing trade creates economies of scope. To see why, go to figure 18.3. Imagine that both countries let's go to figure 18.3 and
joint production possibility frontier. Now the budget constraint is 48 hours. If we're combining both.
if both countries only produce roses, they set their workers to work.
Right, then we're making 36 roses. And if both countries do computers, when we're doing 11.
24 hours a day producing roses, then we end up with 36 roses. How do we know that? Well, look at figure 18.2. If both countries only produce roses, we get 36 roses.
Yeah, okay. So this is basically combining the US and Colombia rose and PUC production. Okay. So y intercept $36. Yeah.
24 in Colombia, 12 in the US. If both countries only produce computers, we get 11 computers. 8 in the US, 3 in Colombia. Okay? Now, but what happens if the countries specialize? What if the US only produced computers and Colombia only produced roads?
All right, so we're going to so here
roses. Well, how many computers we get? We get 8 computers.
well, we get the max, yeah, each. Right, and because yeah, okay. And so the I should have labeled that point, but the point, the midpoint, 24.8 equals when both countries, specialize in what they are comparatively in producing what they have a comparative advantage in.
Economies of scope. Not through any magic, but simply through comparative advantage yielding specialization. And that's the key insight of trade theory. The comparative advantage yields specialization. LeBron should just play basketball. I should just do economics. My landscape contractor should just mow my lawn. LeBron shouldn't mess with mowing his lawn. I shouldn't mess with mowing my lawn. Okay? And the bottom line is if you have comparative advantage in a certain activity, you should specialize in that activity. By doing so, you create economies of scope, which we also call gains from trade. Gains from trade. You create gains from trade by allowing folks to specialize. Okay?
Cool. Very, very
So to
great.
see that
Very good explanation.
further, let's imagine that the relative trading price of computers is 4. Now, you know what the relative prices are with autarky. Once we open up to trade, it's going to depend on demand, right? You can't tell me in a world with trading what price is going to be. I'm going to have to choose the demand curve. Okay. In autarky, it doesn't matter what demand is, right? Perfect competition dictates this. With trading, it matters. It depends how much we want computers relative to roses, and we don't know that yet. So I'm going to make life easy. I'm going to come back to this. I'm going to start by just assuming that the price of computers, there's free trade, and on the world market, the price of computers equals 4 times the price of roses. I'm just going to assume that in the world market, that's what happens. I'll come back to how you get there. But for now, it's easy to just start with assuming that. So you open up to trade, and let's assume the price for computers is 4 times the price of roses. Okay? Well, what you can see is that by specializing, we open up new consumption opportunities. Go to figure 18.4. The red line
Oh, I've been misspelling Colombia this whole time. Colom. Oh well. Well, Colombia.
in figure 8.
Is it Colombia? Colombia. Colom.
18.4 was the autarky possibilities. We saw that already. The blue line is with world trade at a price of 4, the trade possibilities. The blue line is everywhere outside the red line. Each country can do better with trade, or they can do no worse. So if Colombia only wants roses, they're no worse off with trade. But if they want any computers, they're better off. Why? Because they can produce roses cheaply and trade them for computers. The US, if it only wants computers, is no better off with trade. But if it wants any roses, it's better off. Because it can produce computers efficiently and then sell them cheaply for roses. So by allowing each country to specialize, we can allow for expanded production possibilities. By allowing each country to specialize, we can allow for expanded production possibilities. Okay? So basically, what this means is, as long as, with a price ratio of 4, okay, as long as countries want some of what the other country has, you are better off with free trade than with autarky. And that's the proof. You're better off with trade with autarky. And simply the magic, the magic that's happening here is simply by allowing countries to specialize, you get them to use their comparative advantage to produce more. With autarky, the US was inefficiently forced to produce roses. It's much more efficient to produce computers and trade them for roses. So by allowing that trade, we allowed more consumption possibilities in both the US and in Colombia. Questions about that? Now, in this example, I made up the price. So let's think more generally. Yeah, I'm sorry.
So how does comparative advantage play into what economic trade? Like what does that comes out?
Great question. So what I've missed from this model is the whole demand side. What they decide to give themselves what side of trade is going to depend on the relative demand for computers and roses across the countries. That's going to yield this price, which I just made up. So basically, what they're going to decide to do is going to depend on how much each country wants computers and roses. Okay, so to see that, let's go to figure 18.5, which is a little confusing.
US transitions from roses to computers. Computers to roses. Okay.
Okay, but basically what this says is, let's start at point B. Okay, let's imagine we're at point B. At point B, okay, the price ratio is 4. Okay, 4 cartons of roses yield 1 computer. Okay, but let's say that at point B, there's an overall increase in world demand for computers. Folks want more computers than point B. So point B yields 8 computers a day. And let's say the world in general wants more than that. Okay, so in that case, you would move down from point B along that slope segment towards C. Columbia would then say, look, I'm going to start producing computers. Okay, it's relatively inefficient, but if the world really wants them, that's what I'm going to do. I'm still going to trade, but I'm not going to purely specialize. So pure specialization is a special case. In general, countries, whether they'll only purely specialize under certain conditions, generally countries will produce some of both. But
Yeah. Because the demand yeah.
they'll still relatively specialize in the thing they have a comparative advantage in. Let me say that again. Pure specialization only emerges as a particular case. In general, countries will shift, once you open up international trade, countries will shift towards producing the goods they have a comparative advantage in. They might not go all the way. It won't be as extreme as my pure specialization example, but the direction is clear.
Yeah.
Now, at some point that will end. Okay? Imagine that we get to a point where the price of computers relative to roses is 10. Imagine demand for computers is such relative to roses, the price of computers relative to roses is 10. Well, basically, that would say a Colombian producer says, look, I have a choice. I can give up 1 box of roses and get 10 computer. And I'm sorry, basically, if I produce 1 computer, it will yield 10 boxes of roses. If the world price gets to 10, it'll yield 10 boxes of roses. At that point, Colombia will say, forget it, I'm just going to produce computers too. Okay? So you can imagine a world where everyone specializes in computers. Likewise, the price of computers is low enough, everyone can specialize in roses. So where you end up on this graph depends on the relative demands. That is much more complicated. I'm not going to model that. I go back and forth, model that, that'll take another half hour, it's not worth it. I think we can get the intuition without the model. Okay? The basic intuition is, A, for prices in a broad range, from a price of 3/2 to a price of 8, prices in that range, there'll be some specialization. As long as we're somewhere on that PPF, there'll be some specialization. If prices get too low or too high, you want a specialization anymore. But in general, you get specialization. How much specialization?
I need a quick break. Quick chess break before we finish off the lecture. Can we get a Crazy House game? No. Let's try a we'll go bullet. Just one or two. One or two. And one day this opening will work, maybe. I mean, anything can work in bullet, right? It's bullet. You know, no, I actually like this, and then castling, and then we can hit this. Okay, whatever. Then he's going to be able to take his takes, and then he could do this. good. It's not great. Well, it's just, yeah. But I can hit this twice. Take that and it's not good. Not good. Not good. I'm way down on time. This is not good at all. Not good. Oh no. Oh no. Oh, am I mated almost? No, I'm cooked. Oh, I had the rook. I had the rook. Okay, one more. Okay. I'll take that. He's moving a little bit too quick. And he's quit. Okay. Okay. Okay, let's
Civilization
finish
you're going to get
it
is depend on the relative demand for the two goods. If the world mostly wants computers, then the US will produce more computers than Colombia. Colombia will still produce some. If the world mostly wants roses, then Colombia will produce more roses than the US, but the US will still produce some. Okay? Questions about that? So the bottom line is comparative advantage yields specialization, and that yields gains to trade. So that's the thought linkage, okay? Comparative advantage means that folks want to specialize, which yields gains from trade. If there was no trade, LeBron would have to mow his lawn. Okay? Think about that. If there was no trade, LeBron still cares about his lawn, still have to mow his lawn. That would be giving up basketball we all value at many, many times his mowing his lawn. That's inefficient. We are happy to trade me mowing LeBron's lawn for getting to watch LeBron play basketball. We're all happy to make that trade, probably even me. Okay, I like basketball. Okay, we're all happy to make that trade. So by not allowing that trade, we make society worse off. That's why free trade makes society better off, because without free trade, people can't take advantage of what they're best at. And that's why we like free trade. Okay, questions about that? Now, that raises the really interesting question of where does comparative advantage come from? If comparative advantage is so important, where does it come from? Well, as LeBron example, it really can come from two places. As the LeBron example illustrates, the first place you comparative advantage is what we call factor endowments. Basically, who's born with what? LeBron was born with an innate ability to better basketball than I am. I'm not saying if LeBron never tried and I spent my whole life, I couldn't be better than him, but he has an enormous advantage physically over me in playing basketball.
So this would be, for Colombia, would be climate, right?
His factor endowment. Likewise, Canada was endowed with massive amounts of forest land. So they have a comparative advantage in producing timber. China is endowed with 1.5 billion people. So they have a factor endowment, comparative advantage, in producing labor-intensive goods. Okay? Basically, certain times countries have factor endowments that give them an advantage, like timber in Canada or labor in China. But comparative advantage can also be created through technology. There's no reason the US is better than, I don't know, Indonesia at producing computers. The US isn't that much bigger than Indonesia, okay? But we've pushed along the technological frontier, largely through investing in human capital, to give ourselves a technological comparative advantage. Comparative advantage versus Indonesia does not come from anything innate. Nothing about the land of the US makes us better at producing computers. You don't grow anything. We're better because we've moved further along the technological frontier. So in other words, comparative advantage can be innate or it can be produced. And that is why a huge debate around international trade is basically how do we get ahead of other countries? If you think about the President Biden's Chips and Semiconductor Act, Chips and Science Act, a lot of what that act did, it put $52 billion into subsidizing the production of semiconductors in the U.S. Maybe you may not know about the semiconductor market. China's semiconductor market, while semiconductors were invented here in the U.S., and we still lead technologically in the innovation semiconductors, we don't produce semiconductors. Indeed, a somewhat scary fact if you follow geopolitics is 75% of all semiconductors in the world are produced within 100 miles of China. Now, if you think that you're worried about a war with China, then that's kind of a worrisome fact. Moreover, there's the view that, gee, we don't have a comparative advantage in trading semiconductors because China produces them all. What if we what if we invested in the technology of manufacturing? Rather than investing in technology of invention, what if you invest in the technology of manufacturing? We got better at manufacturing than China, then we would have a comparative advantage of producing semiconductors, which not only would help our national security, be a vital economic victory. And that's the idea of the Chips and Science Act, is let's put money into investing in cutting-edge manufacturing, not just for economic security, but eventually give us a technological comparative advantage. Okay? So that's another source of comparative advantage. But there's a third source, I should have said three. There's a third source which is not so happy. And we might call it sort of, I don't know of a good label for it, but we just call it destructive routes. Destructive routes to comparative advantage. Let me give a simple example. One reason that China has a comparative advantage not only in things like producing textiles, but producing things like batteries, is because they have really weak environmental regulations. So in the US, if you want to set up a battery factory, you have to pass a battery of tests to show that you're not doing environmental damage, you're not harming the people around you. In China, you don't. So in China, one of the leading battery manufacturing plants was leaking the materials that are made to use batteries, and many hundreds of people died or got sick in the nearby villages. Now, China had a comparative advantage producing batteries. They could do it more cheaply than we could. So we're buying Chinese batteries. But at what cost? At the cost of making our environment worse and harming people around them. You can go further. We often heard the term sweatshops is a term you hear. The idea that people are getting poorly paid to do hard jobs. Many people would argue that China has a comparative advantage in producing things like textiles because their workers are working in terrible conditions and leading horrible lives. Now, we'll come back to that next time and ask if that's really a valid criticism. But other people might call that a destructive route. Or think about child labor. In the US, child labor is banned, rightly. In other countries, it's not. So if other countries use child labor as a way to get a comparative advantage, we might not like that so much. So that's when we start to, next time we'll get this more, that's when we start to see, gee, maybe free trade isn't all it's cracked up to be. If the way you get a comparative advantage can be destructive, then maybe we're a little worried about free trade. We add on top of that the fact that free trade.
So in RimWorld, I had one of my societies went hardcore into organ harvesting anyone who attacked. So I had a comparative advantage in organ harvesting via the destructive. Well, I guess would you say it's like, yeah, it's a destructive route of not being concerned about killing the prisoners, my prisoners, right?
Means that we get cheaper roses, people in the US lose their jobs, and we care about jobs. That's another reason we might be a little worried about free trade. So next time I'm going to start to ask, how do we think about the welfare economics of free trade? And are there arguments against it? And what should governments do if they don't feel free trade is working to the best advantage of the world? Okay.
Fantastic lecture. Innate, produced, destructive. That was fantastic. International trade, welfare, and policy. Very, very cool. Very, 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 very cool. Okay. Cool. We're gonna leave it there for today. These are some fantastic lectures. Really, really, really fantastic. We're coming to the end. We've got 1, 2, 3, 4, 5, 6, 7, 8. And then after this, macro econ and And I found another one which I thought would be interesting. Let me find a study. Well, yeah, I mean, all that RBA stuff will be fantastic. Finance. They have a finance and public policy series as well. And same guy as well. Like, I'm really, really enjoying his teaching style. But this seems super interesting. Got externalities, political economy, social insurance, social security, healthcare, redistribution and welfare, taxation. Yeah, this will be fantastic. Like, yeah, I'm excited for this. And I've also saved this one, I'm pretty sure, but let me just make sure that I have if I haven't, let me just resave it as well. This one was do I not have it here? Game theory. Okay, I'll put it here actually. Game theory. Oops. There. Great. And I'll make that a checkbox. That is going to be sick. It's going to be awesome. Cool. Really fun. Oh, I do have it there, but I've already put it in my main thing, so we can delete that there. Intermediate microeconomic theory. Oh. Is this also lecture videos? No. Townsend. Exam solution. Nothing here. Download course. What is this? Lecture. Oh, these are videos. Okay. Oh, this will be sick too. This will be great too. Angrist. Randomized control trials versus quasi-natural experiments. Huh. Okay. I don't know. I don't know what quasi-natural experiments are, but yeah, there's a lot. Anyway, very, very cool. Lots to do. That was a lot of fun. I enjoyed that. Yeah, I'll catch you guys next time.